Hey everyone, welcome back to Corporate Decoder, the place where we, decode corporate filings. Today, we're diving into a recent Form 8K from Unity Software. I know what you're thinking, an 8K. Sounds riveting, but stick with me because underneath the legal jargon, there's a story about debt, deals, and a little bit of financial maneuvering. This isn't just about numbers, it's about where Unity is heading. So when can these notes actually be converted? Well, holders can convert if Unity's stock price does well, if the trading price of the notes dips too low, if Unity decides to redeem or buy back the notes, or if certain big corporate shakeups happen. After December 15, 2029, the holders can convert anytime. This is a way that debt can be converted into equity, which is the company's valuation. The initial conversion rate is set at 27.6656 shares per $1,000 worth of notes, which translates to a conversion price of about $36.15 per share. This price is about 32.5% higher than where Unity's stock was trading back in February of 2025. Keep in mind that this conversion rate can change under certain conditions. It's not set in stone. Unity can't just buy back these notes whenever they feel like it. There's a lockout period until March of 2028. After that, they can redeem them for cash if their stock price is high enough for a sustained period. There's no sinking fund, meaning Unity isn't required to set aside money each year to repay the debt. Now, what happens if Unity gets bought out or goes through a major change? The note holders have some protection. They can force Unity to repurchase their notes at 100% of the principal amount, plus any unpaid special interest. This is a pretty standard clause to protect investors in case of a big corporate event. Of course, there are events that would trigger a default on these notes, the most obvious being failure to pay interest or principal when due. Other triggers include failing to comply with conversion obligations, not providing required notices about major changes, or a significant debt default elsewhere in the company. Also, bankruptcy or insolvency events will trigger the notes to be due immediately. There are rules around Unity merging with another company or selling off all its assets. Basically, the new entity has to take on Unity's obligations under these notes, and there can't be any existing defaults. These provisions exist to make sure the note holders are protected if Unity undergoes a significant change in its corporate structure. If you want to dig into the nitty-gritty details, the actual legal document, called the indenture, is filed as an exhibit to this report. It spells out all the terms and conditions in excruciating detail. Alongside issuing the notes, Unity entered into what are called capped call transactions. These are basically deals with financial institutions designed to reduce the potential dilution, that is, to reduce the increase of the number of shares if the notes get converted into stock, and to offset some of the cash payments Unity might have to make. It's a way to manage the risk associated with convertible notes, with the cap initially set at $47.74 per share. Because this issuance of debt creates a direct financial obligation for Unity, it has to be reported in this filing. It's a pretty standard requirement when a company takes on new debt. The company sold these notes to institutional buyers, relying on exemptions from securities laws for private offerings. Any shares issued upon conversion of the notes are expected to be exempt from registration too. Unity put out a couple of press releases about this offering, one announcing it and another announcing the pricing. These are included as exhibits to the report. Now, let's zoom out and put this all together. Unity's decision to issue these convertible notes is a move to manage its debt and potentially fund future growth.